Welcome back to the Deep Dive. We're here to break down complex company results into, well, the key things you need to know. Today, we're tackling the Q3 2025 financials from a major global bank.
Yeah, and our goal here is really to cut through the complexity, find what's actually driving things, across consumer, investment banking, wealth management. We're looking closely at year over year and also those quarter-over-quarter changes, what really shifted.
Okay, and the headlines definitely stand out. Q3 2025 net income, $14.4 billion. That's up a solid 12% from last year. Managed revenue also strong, $47.1 billion, which is up 9% year over year.
And that key profit number, the return on tangible common equity, or ROTCE, it hit 20%. I mean, 20% is huge. It really signals efficiency, strong operating leverage.
Sounds like a clear win, right? But then the CEO's comments add, well, a layer of caution. They talk about strong results, sure, but also flag that the U.S. economy, while resilient, is seeing maybe some softening in job growth.
Exactly. And that's the interesting part. How do you balance these great internal results with external worries? They specifically mention heightened uncertainty, geopolitics, tariffs, trade issues. Plus, you've got these high asset prices alongside inflation risks that just won't go away. We need to see how that plays out in their strategy.
All right, let's dig into the firm-wide numbers first. That $47.1 billion revenue figure. Let's break that down. It's net interest income, NII, and non-interest revenue, NIR.
Right. NII, what they earn on loans minus what they pay on deposits, was $24.1 billion. That was up just 2% year over year. But the NIR, that's fees, trading, asset management, that shot up 16% to $23.0 billion. That's where a lot of the action was.
So to really understand the core health, we usually strip out the markets part, the trading revenue, because it can be pretty volatile. What does NII and NIR excluding markets look like?
Yeah, that's crucial. NII without markets was actually flat year over year, $23.4 billion. Now, flat might not sound amazing, but given the pressure's lower rates, tighter deposit margins holding flat was actually quite an achievement. They managed it internally. Higher revolving balances on credit cards, for one, and bringing in more wholesale deposits. Volume basically offset the margin squeeze.
Okay, so they actively work to stay flat there. Got it.
Yeah.
What about the core NIR, non-interest revenue, without markets? That was up 16% to $14.8 billion. That's pretty strong.
Absolutely. And it wasn't just one thing, it was broad. Higher fees from asset management, a good lift in investment banking fees, also more income from auto leases, and higher payments fees. It shows the whole client business, is really humming.
And just to quickly touch on that markets revenue we pulled out, it was massive, $8.9 billion, up
Yeah.
huge 25% compared to last year.
Yeah, a record third quarter for them, probably driven by all that uncertainty we talked about. Volatility tends to fuel trading activity.
Okay, let's connect this back to costs and risk. Non-interest expenses were up 8% year over year, landing at $24.3 billion. But you're saying this wasn't just bloat.
No, the drivers make sense with the growth. Higher compensation, partly tied to the better revenue, but also hiring more people in the front office. Plus, more spending on things like marketing, brokerage fees, even auto lease depreciation. They're investing to grow.
And what about credit? How are they viewing potential loan losses?
Well, the provision for credit losses went up 9% year over year to $3.4 billion. Actual net charge-offs, so loans actually written off, were $2.6 billion. That's up about $500 million, mostly from wholesale and card services.
And this is where that CEO caution really hits the books, right? They added to their reserves.
Exactly. A net reserve build of $810 million. They're setting aside money for potential future losses. About $608 million of that was for consumer, $205 million for wholesale. It's them saying, okay, things look good now, but we see those clouds the CEO mentioned.
Right, nearly $1 billion earmarked for potential future trouble. Okay, let's zoom into the segments. Starting with consumer and community banking, CCB, net income there was $5.0 billion, up 24% YoY, and a 35% return on equity. Wow.
Yeah, 35% ROE in retail banking is phenomenal. Really strong performance.
And looking at the revenue streams within CCB, banking and wealth management was up 9%. Though there's a note here about something called funds transfer pricing, helping this number.
Ah, right. Funds transfer pricing. Basically, it's internal bank accounting, how they allocate costs and revenue between divisions. So a change there boosted CCB's reported revenue from consumer deposits, but it got completely canceled out in the corporate segment's numbers. The key thing for you, the listener, is that this wasn't like a change in customer fees or new business. It was just internal bookkeeping.
Okay, good clarification. So more fundamentally, card services and auto revenue was up 12%. And that was mostly higher NII from card services, driven by higher revolving balances, so people carrying more debt on their cards.
That's a big piece of it, yeah. That's the engine driving that growth. And you see the scale in the customer numbers, active mobile users, almost 61 million, up 7%. That's a massive digital base. And card spending, debit and credit combined, nearly $500 billion in the quarter, up 9%.
Plus, their push to get more investment business from retail clients seems to be working. Client investment assets reach $1.23 trillion. That's up 15% year over year.
Now, the crucial check, credit quality in that consumer segment, given the rise in balances, you'd watch this closely. But total net charge-offs were $2.0 billion, only up slightly. And interestingly, the card services charge-off rate actually went down a bit. It was 3.15% compared to 3.24% last year. So despite higher balances, the actual loss rate improved. That's positive.
Yeah, that is a good sign operationally. Right. And the reserve build there, $575 million, you said, was mostly for expected loan growth and those macro variable updates, not like immediate red flag.
Correct. More proactive provisioning based on growth in the outlook rather than reacting to current deterioration.
Okay, moving over to the Commercial and Investment Bank, CIB. Net income here was $6.9 billion, up 21%, with a solid 18% ROE.
And investment banking fees were really strong, $2.6 billion, up 16% year over year, and also up 5% from just last quarter. That momentum is important. Growth across advisory, equity underwriting, debt underwriting, they held on to that #1 spot in global IB fees.
And the markets and trading within CIB. We mentioned the overall number was huge, $8.9 billion, a record third quarter.
Yeah, digging in a bit. Fixed income was up 21%, driven by rates, credit, securitized products, pretty broad strength, and equity markets jumped 33%, largely thanks to their prime brokerage business.
So incredible revenue generation in CIB. But here's where we saw that big warning sign on the credit side, right?
Mm-hmm.
The provision for credit losses in CIB just exploded, up 156% year over year to $809 million.
It's jarring, isn't it, compared to the revenue picture? And the net charge-offs tell the story. $567 million. That's up 263% from last year. This wasn't just a small uptick, and the filing was quite specific. It linked these charge-offs to, quote, borrower-related collateral irregularities in certain secured lending facilities.
Collateral irregularities. That sounds not good. It suggests maybe fraud or at least a major miss in managing the collateral backing those loans. It really underscores the risks in wholesale lending. You can have these amazing quarters on the trading side and then get hit by one specific really bad situation on the lending side. A big reminder that risk isn't always about the whole economy.
Exactly. It's a stark contrast within the same division. Okay, let's shift to Asset and Wealth Management, AWM. Net income here, $1.7 billion, up 23% YoY, and the ROE was an incredible 40%.
40%, wow. And the story here is clearly asset growth. Assets under management, AUM, hit $4.6 trillion, that's up 18%. And total client assets were even higher, $6.8 trillion, up 20% year over year.
And that growth comes from two things, really. One, clients are still putting money in strong net inflows, but two, markets have been up. Those higher average market levels are boosting the value of existing assets. So this segment is directly benefiting from those elevated asset prices the CEO mentioned as a potential risk.
You can see the client confidence in the flows. $109 billion in net inflows just in Q3. Mostly long-term money, but also liquidity. And that inflow directly fuels revenue, which was up 12%, mostly from management fees.
Expenses grew too, up 5%, mainly higher pay as they hire more private banking advisors to capture more of that wealth market.
And credit in AWM, usually pretty clean, but they did have a provision of $59 million.
Right, and again, very specific. The filing says it was a charge-off related to a single client, so another isolated incident, not a broad trend.
Okay, let's wrap up with the overall balance sheet and the outlook. How strong are they looking? Capital ratios.
Very strong. Fortress balance sheet, as they like to say. The main capital ratio, standardized CET1, was 14.8%, well above requirement.
And liquidity.
Massive, $1.5 trillion in cash and marketable securities. Huge buffer there. That gives them enormous flexibility and resilience.
And they're returning value to shareholders. Tangible book value per share up 10% YoY to over 105 LARs. Plus, they paid out $4.1 billion in dividends and bought back $8 billion worth of their own stock.
Yeah, significant capital return. And looking ahead, their guidance for the full year 2025 suggests they expect the momentum to continue. They're implying around $92.2 billion in net interest income, excluding markets, for the full year, and about $95.9 billion in adjusted expenses. That expense number suggests they plan to keep investing significantly into next year.
Okay, so let's try and pull this all together for you, the listener. We've got really strong overall profit, record results in areas like markets. The consumer business looks solid, lots of client activity, good digital engagement, investment banking fees are strong.
Right, lots of internal momentum. The machine is working well, but, and it's a big but, you have these counterpoints. That really large specific credit loss in CIB stands out. And then there's that persistent caution from the top about the macro environment. Geopolitics, inflation, high asset prices, it hangs over everything.
So it really paints a picture of a company performing incredibly well operationally, while navigating some very specific internal risks and broad external uncertainties.
Which brings us to a final thought for you. We saw that asset and wealth management had that huge 20% growth in client assets, largely thanks to higher market levels. The CEO called those high levels part of the heightened uncertainty. So the question is, if those market levels do correct sharply, given the risks management themselves are flagging, what happens to AWM's growth? How much would that impact their overall picture, even with that fortress balance sheet?
Something to definitely think about. How much is current success tied to market levels that even management seems wary of? Okay, that's our deep dive for today. Thanks for joining us. We'll catch you next time.